Welcome to the deep dive. This is where we take a whole stack of information, could be reports, articles, maybe even your own notes, and we pull out the absolute key insights for you. Our goal today, cut through all that noise and give you a really solid understanding of a major global security company. We're digging into a pretty fascinating company today, one that's definitely at a crossroads. It's Allegion plc, trading on the NYSE, ticker ALLE. Now, this isn't just about, door locks anymore. We live in this age where digital convenience and physical security are crashing together. So the big question we're tackling is, can a legacy industrial player like Allegion hold on to its market leadership while also pioneering the very tech that could disrupt it? We're going deep. A full fundamental analysis using data right up to June 18th, 2025. And by the end of this, you should have a much clearer picture of whether Allegion's security fortress is, well, truly solid, or if maybe there are some hidden cracks we need to worry about.
That's exactly right. We'll be looking at the business itself, the management team, its financial health, and crucially, what we think its intrinsic value might be, all from the viewpoint of someone looking to invest for the long term with a value focus. And hopefully you'll walk away understanding their big strategic shift and the hurdles they're facing.
Okay, let's get started then. Chapter 1, Business Analysis, the bedrock of security. So Allegion's mission statement talks about pioneering safety and security, creating a safer world. Sounds good. But how do they actually make money doing that?
Well, their core business is designing, making, and selling a whole range of security products and solutions. They structure it geographically. You've got Allegion Americas and Allegion International. And for the full year 2024, Allegion Americas was really the powerhouse. It brought in 80% of their total $3.77 billion revenue.
80%? Wow. Okay.
Yes, substantial. So international is the other 20%. But what's really interesting, I think, is the product mix. Traditional mechanical hardware, think standard locks and keys, that still makes up 68% of their 2024 revenue.
Still the majority then.
It is, but the electronics category, it's going fast. It's now a significant 25% of sales. And then software and services make up the last 7%. So you can really see it there, right? They still depend heavily on the legacy stuff, but there's a very clear strategic push towards electronics.
Right. That 25% is definitely something to watch. So when we talk about these security solutions, what specific brands or products are we talking about? What might people recognize?
Oh, it's a huge portfolio. They serve institutional clients, commercial, residential, the whole spectrum. You've got really iconic brands like Schlage. You've probably seen that name. It was named America's most trusted door lock brand again in 2024. That's 5 years running.
Impressive. Okay.
Yeah. Then there's Von Duprin. They're big in panic bars, emergency exits. LCN for door closers. And internationally, or more on the electronic side, you have brands like CSA, Interflex, SimonsVoss. Their whole strategy, it's about providing complete solutions.
Yeah.
Securing everything around the door and adjacent areas, not just the lock itself.
Okay, so a wide range, well-known brands. How big is their actual footprint on the global stage? You mentioned 15% market share earlier.
Yeah, they're definitely a heavyweight. They operate in something like 130 countries, 34 production facilities around the world. And as of early 2024, that estimate was about a 15% share of the global security and access control market. That $3.77 billion in 2024 revenue puts them right up there. And that scale, it gives them huge advantages: manufacturing, supply chain, distribution. It creates really high barriers for smaller competitors trying to break in.
That makes sense. So with that scale and those brands, what's the core promise to customers? Why choose Allegion?
It really boils down to trust and reliability. They're selling peace of mind.
Yeah.
High-quality products that you know are going to keep people and assets safe. Flawless, seamless access. And it's backed up by deep expertise in all the security standards and how these systems work together. It's about dependability.
And the industry itself. We hear so much about smart homes, IoT. Where's the growth actually happening in physical security? Is it all digital now?
The overall market is definitely growing. It was valued around $113 billion in 2024 and projected to hit almost $196 billion by 2032. That's a solid 7.2% compound annual growth rate.
Okay, healthy growth.
Very healthy. And yes, overwhelmingly, that growth is being driven by technology convergence. AI and video surveillance, IoT integration, cloud platforms for security, plus, rising security concerns, generally more urbanization, smart buildings. Those trends help too. But this creates that core tension for Allegion, right? Their history, their main revenue source is mechanical, but the future growth, almost entirely electronic and digital. Their M&A strategy, their R&D spend, it's all a direct reaction to needing to bridge that gap.
That tension seems critical. Who are they up against? Who are the main rivals in this fight, especially as it gets more tech-focused?
It's a competitive field, no doubt. You've got the big industrial names like ALLE, Stanley Black& Decker, Resideo Technologies, also firms like ADT. And the name of the game right now is intense R&D and strategic acquisitions. Everyone's racing to build up their electronic and software capabilities. But, it's not easy just to jump into this space. Those barriers to entry we mentioned, they really protect players like Allegion. Decades of brand trust shillage, for example. Deep distribution channels, huge economies of scale, and that specialized technical know-how, especially for commercial buildings with complex codes. It's hard to replicate that quickly.
Okay, so barriers are high, but what gives Allegion its specific edge, its competitive advantage, its moat, as they say?
Well, the most obvious one is brand strength. That translates directly into pricing power, customer loyalty. People trust those names. Then you have the economies of scale, giving them cost advantages. But here's where it gets really interesting, I think, especially in commercial and institutional markets. It's their specification-driven sales model.
Specification-driven? How does that work?
Basically, their products get written into the building's blueprints right from the start. Architects and specifiers choose Allegion products during the design phase. Once those products are designed in and installed, replacing them is incredibly expensive and disruptive. Think about ripping out all the doors and hardware at a hospital or a school.
Oof, yeah. You wouldn't want to do that.
Exactly. So it creates extremely high switching costs. It essentially locks in the customer for the life of that building, pretty much. And that leads to a long stream of recurring revenue from maintenance, upgrades. It makes them much less vulnerable to just competing on price. They even have special teams, specification writers, consultants, who work directly with architects early on to get Allegion products embedded. It's a very effective strategy.
That lock-in sounds incredibly valuable, especially for generating predictable revenue. Okay, that tees up our next section nicely. Let's talk about the people making these strategic decisions. Chapter 2, Management Evaluation. John H. Stone became CEO in July 2022. What's his story? Why was he brought in at this specific time?
Yeah, Stone's appointment looks very strategic. He spent 20 years at Deere & Company, the tractor company. And crucially, he led their intelligent solutions group. He was deeply involved in bringing AI, machine learning, precision tech into Deere's traditional heavy equipment business.
Transforming a legacy industrial company. Sounds familiar.
Exactly.
Yep.
His background aligns perfectly with Allegion's need to pivot towards electronics and connected solutions. Since he took over, they've kept up operational discipline, but they've definitely accelerated the tech-focused M&A. And, the record financial results in 2024, that provides some pretty solid, tangible evidence that his team is executing effectively so far.
And how do they stack up on transparency and ethics? Are they open with investors? Do they seem to operate responsibly?
They seem pretty transparent, yes. Their investor relations website is quite comprehensive. Easy to find earnings reports, presentations, SEC filings. Management does a good job breaking down metrics, like clearly showing reported versus organic growth. That's helpful. Ethically, they seem solid too. Robust governance structure, detailed code of conduct, zero tolerance on retaliation, an ethics and compliance program reporting right up to the CEO and audit committee. They even won a Gallup Exceptional Workplace Award in 2024, which suggests a pretty healthy internal culture.
Okay, sounds positive. Now, a key job for any management team, especially one driving a transformation, is capital allocation. How does Allegion decide where to put its money?
Their strategy seems very clear and balanced. They talk about prioritizing organic growth investments first, then strategic M&A, and finally shareholder returns. But M&A is definitely a cornerstone right now. It's their main tool to speed up that pivot into electronics, broaden the product line, and get into new regions. They have discipline criteria too. Deals need to leverage their core strengths, offer synergies, boost organic growth, improve the financials, and this is key. Generate an ROIC, return on invested capital, that's higher than their WACC, their weighted average cost of capital.
So they have rules for the deals they do.
Right. And it's not just talk. They've set a big target. Deploy about $2 billion in available cash flow over the next 3 years. And get this, 50% of that is earmarked for M&A.
Half of it, that's aggressive.
It is. And we're seeing it happen. The
Yeah.
big one recently was acquiring Tech in June 2025 for $330 million earn-out. They're a German leader in RFID tech, plus Novus in Australia, Trimco Hardware, and 5 other businesses just in 2024.
Okay, clearly M&A is a huge focus. What about returning cash to shareholders directly? Dividends, buybacks?
They have a really strong track record there too, especially with dividends. They've increased the dividend for 11 straight years as of early 2025. The latest bump was 6%, up to $0.51 per share quarterly, and it's very well covered by earnings. The payout ratio is only around 27–28%, That leaves a lot of cushion and room for future hikes.
That's a safe dividend then.
Very safe. And they're buying back shares too. $40 million in Q1 2025, $100 million in Q4 2024. So a balanced approach overall.
You mentioned ROIC, return on invested capital, earlier in their M&A rules. How has that metric actually been performing for Allegion recently?
Historically, Allegion's ROIC has been excellent, consistently above 20% for many years. Really strong. However, one analysis we saw pointed to a recent decline in ROIC, averaging about 1.8 percentage points lower each year over the last few years.
A decline. Is that a red flag? Does it mean the business quality is slipping? Not necessarily, and this is important to understand. It seems to be a predictable short-term result of that aggressive M&A strategy. Big acquisitions cost a lot upfront, right? And the financial benefits, the actual returns from those deals, often take several years to fully kick in and integrate. So management's own criteria acknowledge these are long-term investments. That temporary dip in ROIC, you could see it as a leading indicator of their future strategy, not a sign of current failure. You really need that multi-year view to judge it properly.
Right, it's an investment phase.
Yeah.
But the risk is if those returns don't materialize as expected down the line.
Exactly. That's the execution risk inherent in any big M&A push. Will the synergies come through? Can they integrate effectively? It's something investors need to watch closely.
Okay, that makes sense. Let's move on to the raw numbers then. Chapter 3, financial analysis. What story do the financials tell? What's their market cap now?
As of our analysis date, June 18, 2025, Allegion's market cap was about $11.77 billion. So solidly large cap.
And revenue growth over the last 5 years, how's the top line looked? It's been pretty consistent overall. A 6% compound annual growth rate over the 5 years leading into 2025. If you look year by year. 2020 saw a dip, down 4.7%, likely pandemic-related. Then recovery in 2021, up 5.4%. Strong growth in 22 and 23, up 14.1% and 11.6% respectively. Then more moderate growth in 2024, up 3.3% to $3.77 billion. But again, it's vital to distinguish reported versus organic growth. For FY 2024, organic growth was 2.1%. Q1 2025 was 4.0%. So M&A is clearly boosting that headline number significantly.
That organic number is quite a bit lower. What about profitability, though? Are those strong brands translating into good margins?
Absolutely. Profitability is a real highlight for Allegion. It shows that pricing power. Gross margins are consistently strong, around 43% to 44%. They actually hit 44.9% in Q1 2025.
Very healthy.
Yeah. Operating margins are also robust, averaging 19-20%, and they've been trending up. 20.7% for the full year 2024 and 20.9% in Q1 2025. And their trailing 12-month net profit margin as of March 2025 was 16.3%. These are impressive numbers for an industrial company.
They really are. And how good are they at turning those profits into actual cash they can use? Cash flow generation.
They are a powerful cash machine. They like to talk about available cash flow, which is basically free cash flow readily available for deployment. That number was $582.9 million in FY 2024, up almost 13%. And in Q1 2025, it improved dramatically to $83.4 million. Analysts expect that strong free cash flow to continue growing too, maybe reaching close to $800 million by 2028. So plenty of fuel for investments and returns.
Okay, strong cash flow. What about financial stability? How consistent are earnings, and what's the debt picture look like? Is it manageable?
Earnings have shown a steady, resilient upward trend. Diluted EPS grew from $4.26 in 2019 to $6.82 in 2024. That's a 9.2% compound annual growth rate for EPS, actually outpacing revenue growth.
Good sign when earnings grow faster than revenue.
It is. And they consistently beat analyst EPS estimates too. Now, debt. End of 2024, total debt was about $2.0 billion against equity of $1.5 billion. That gives a debt-to-equity ratio of 1.33. Some reports say that's higher than the industry average, but it doesn't look alarming given their very strong, predictable cash flows. Their interest coverage ratio is high, 9.7 times, meaning operating earnings easily cover interest payments many times over, so debt seems well managed.
And short term, do they have enough cash on hand for immediate needs, liquidity?
Yeah, very comfortable there. Their current ratio is 2.17 recently, meaning current assets were more than double current liabilities. That's a significant buffer for any short-term obligations or surprises. Lots of flexibility.
We touched on the dividend history. Just to confirm, it looks stable and growing.
Absolutely. It's a key part of their identity. 11 straight years of increases, low payout ratio around 27%, so it's safe with plenty of room to grow. And the 5-year dividend growth rate is over 11%. Very reliable.
Okay, let's try to value this. How does their price to earnings ratio look compared to peers and their own history? Is it expensive, cheap, or fair?
Right now, as of the analysis date, their trailing 12-month PE ratio is about 19.2x. What's interesting is that's quite a bit lower than their own 10-year average PE, which is closer to 25.9x. So it's trading at maybe a 25% discount to its historical average.
Suggests the market's a bit pessimistic right now.
It does seem that way. Compared to direct competitors, it's kind of middle of the road. Higher PE than, say, Residio or ADT, but lower than Johnson Controls or Trane Technologies. So not screaming cheap, but definitely not expensive relative to its history.
Beyond comparing PE ratios, how do we estimate its fundamental or intrinsic value? You mentioned discounted cash flow earlier. Can you briefly explain that again?
Sure. A DCF analysis tries to figure out what a company is truly worth based on the cash it's expected to generate in the future. The basic idea is that a company's value today is the sum of all its future cash flows, but discounted back to their present value. We use a discount rate, often the WACC, weighted average cost of capital, which reflects the riskiness of those future cash flows. It gives you a value estimate based purely on fundamentals, separate from whatever the stock market happens to be doing that day.
Okay, a fundamentals-based approach. So applying that DCF model to Allegion, what kind of intrinsic value estimate do we get?
Based on an educational model, using publicly available analyst consensus forecasts for cash flow, the base case intrinsic value estimate comes out around $133.75 per share. Now, because forecasts always have uncertainty, the model also gives a range. In this case, roughly $121.77 on the low end to $145.73 on the high end.
And what are the really critical assumptions driving that $133.75 number? What inputs make the biggest difference?
Absolutely, the assumptions are crucial. Key inputs would be the growth rate used for future cash flows. So maybe mid-single digits, 4–6% for the next few years, aligning with analyst forecasts and management targets, then tapering down to a long-term perpetual growth rate, maybe 2–3%, like long-term GDP growth. The other big one is the discount rate, the WACC. For a stable industrial company like Allegion, you'd probably use something in the 8% to 10% range, which interestingly aligns with their own M&A hurdle rate needing ROIC to exceed WACC.
Got it. Okay, now we've looked inside the company. Let's look outside. Chapter 4. Market sentiment. How is Wall Street actually feeling about Allegion right now? What's the vibe?
The vibe is cautious and definitely divided. The consensus rating from the 9 analysts covering it is a hold, not a buy, not a sell. And the median 12-month price target is $128.26. That's actually below the share price of $136.80 when we looked.
Below the current price.
Yeah, though another source had a slightly higher mean target, around $140. But look at the range in those targets, from $100 all the way up to $150.
That's a huge spread.
It really is. It tells you there's a real lack of agreement among analysts. It highlights that central debate we keep coming back to. Can this high-quality business overcome the current economic headwinds and successfully execute this tech pivot? The market seems unsure. It's waiting for more proof, basically.
A wait-and-see mode. What about the news flow, general media coverage? Is it leaning one way or the other?
Mostly neutral, focusing on the facts. Quarterly earnings reports tend to get positive coverage because they often beat expectations. You see headlines about solid execution or strong margin expansion. Big strategic news like that ALLE Tech acquisition was widely reported as a positive step. But on the other side, you also see factual reporting about insider selling by some executives, which kind of provides a counter-narrative.
Interesting point about insider selling. Let's delve into that with Chapter 5. Ownership structure. Who actually owns Allegion stock?
Okay, ownership is overwhelmingly institutional. We're talking 99.6% to 99.8% held by large financial institutions like pension funds, mutual funds, etc.
Almost entirely institutions.
Pretty much, which gives it a stable base, you could argue. But it also means the stock price can be heavily influenced by what a few big money managers decide to do. And it's quite concentrated. The top 25 shareholders control nearly 69% of the company. Think Vanguard, BlackRock, Boston Partners, the usual big names. Recent filings show a mix, some adding to their positions, others trimming. No clear trend there.
What about the insiders themselves, executives, directors? How much of their own money is tied up in the company?
Direct insider ownership is actually quite low, around 0.26% of the total shares. That's not really unusual for a big, mature company like this. However, the pattern of recent insider trades is really interesting and sends kind of conflicting signals. You've had several senior vice presidents consistently selling shares over late 2024 and early 2025.
Selling. That doesn't usually look great.
It doesn't always look great, but it's often part of prearranged trading plans, 10d5-1 plans, or selling to cover tax liabilities from stock awards.
Yeah.
So it doesn't automatically mean they lack confidence.
Okay, so maybe not a huge red flag, but you said conflicting signals.
Yes. Because here's where it gets really fascinating. What's the CEO doing?
Right, the guy with the ultimate view.
Exactly. CEO Johnstone. He's doing the complete opposite. He's been a significant, consistent buyer of Allegion stock on the open market. Bought 7,500 shares in December 2024. Over the last 18 months, he's bought a total of 22,500 shares. That's millions of dollars of his own money. Plus, another director, Greg Senkstack, bought 8,000 shares in February 2025.
Wow, okay, that's a strong signal. Selling can happen for lots of reasons, but big open market buying usually only happens for one reason.
Precisely. Insiders typically only make large open market buys when they genuinely believe the stock is undervalued and likely to go up. The CEO, who knows the strategy inside out, is putting serious personal capital behind it. That's a powerful vote of confidence, especially when the market seems skeptical.
That CEO buying is definitely a compelling counterpoint to the analyst hold ratings. What about the high institutional ownership concentration? Any implications there?
Just that the stock price could be more sensitive to shifts in sentiment at those top firms. If one of the top 5 holders decides to significantly increase or decrease their stake, that could create noticeable buying or selling pressure, maybe a bit more volatility than you'd expect otherwise.
Okay, good to keep in mind. No investment is risk-free, so let's tackle that head-on. Chapter 6, Risk Assessment. Can we start with a quick SWOT analysis? What are Allegion's core internal strengths?
Sure. Strengths are definitely that powerful brand portfolio, Schlage, Von Duprin, etc., market leadership, and scale that 15% share, 130 countries, the robust financial profile, high margins, strong cash flow, and their proven M&A capability, which is crucial for the pivot.
And internal weaknesses. Where are they vulnerable?
Key weaknesses include that heavy reliance on the U.S. market, over 75% of revenue comes from there, makes them susceptible to a U.S. slowdown. Also, the relatively slow underlying organic growth, which makes them so dependent on acquisitions for headline growth. And we saw some vulnerability in the residential market recently. It declined mid-single digits in Q1 2025.
Okay, what about external opportunities? What could really propel them forward?
The biggest opportunity is clearly the ongoing shift to electronic security and smart tech. That global market is projected to hit nearly $85 billion by 2025. That's exactly where their strategy is aimed. There's also potential in emerging markets, especially Asia-Pacific, that could be a $60 billion security market soon. And finally, strategic partnerships. Teaming up with big tech companies or getting into adjacent areas like integrating with platforms like Airbnb could open up totally new sales avenues.
Makes sense. And the flip side, external threats. What keeps them up at night?
Intense competition is always there, from big rivals like ALLE. As products get more connected, cybersecurity risks become a much bigger threat. A breach could be devastating for a security company. And supply chain disruptions are always a risk, whether from geopolitics or material shortages. That global footprint can be a vulnerability too.
How do the big macroeconomic factors like inflation and interest rates play into this? How much do they impact Allegion?
They're very impactful because Allegion is so tied to construction and remodeling cycles. High inflation hits them directly by increasing costs for materials and labor. Rising interest rates make building and renovating more expensive, which dampens demand for their products. Management specifically mentioned the slower recovery in U.S. residential being linked to high rates. So you get this triple squeeze, as some call it, pressure on costs, pressure on demand, and pressure on their ability to raise prices to compensate. It really tests their operational efficiency.
And what about those specific U.S. tariffs imposed in 2025? How big a deal is that for their supply chain?
That's a direct material threat. You've got new duties on imports from China, up to 55%, Mexico, 25%, and Canada, 25%. Now, Allegion says less than 5% of their cost of goods sold, COGS, comes from China, which is good. But Mexico, that's a different story. Around 20-25% of their COGS is sourced from Mexico.
A quarter of their costs potentially hit by a 25% tariff.
Potentially. Management says most of their Mexican imports should comply with the USMCA trade agreement rules and avoid the tariffs. But any changes or disputes there could expose a big chunk of their supply chain. They acknowledge it's a headwind and say they'll try to offset it with price increases, but whether they can do that fully without hurting sales is a major question mark. It's a key risk to watch.
Definitely. Okay, we've covered a lot of ground. Let's synthesize this. Chapter 7, Conclusion. If you had to make the bull case for Allegion, what are the key arguments?
The bull case is built on owning a high-quality, very durable business. They have a dominant market position, protected by a strong moat, those iconic brands, scale economies, and especially that sticky specification-driven model in commercial. High switching costs are huge. Financially, they're superior. Industry-leading margins, powerful cash flow generation. They consistently return capital via that safe, growing dividend and buybacks. Management has a clear, albeit aggressive strategy to pivot to higher growth electronics, led by a CEO with the right kind of transformation experience. And you have that very compelling insider buying signal from the CEO showing strong personal conviction. Plus, all of this is available at what looks like a reasonable valuation, especially compared to its own history.
Okay, that's a solid bull case. But what about the bear arguments? What are the biggest risks or challenges that could derail that story?
Despite the strengths, the risks are significant too. Those macroeconomic headwinds, high rates, inflation create that triple squeeze on demand and profits. That's a real near-term challenge. There's direct tariff and geopolitical risk, especially with that significant Mexico supply chain exposure. The reliance on M&A for growth, given that the slower organic growth, carries inherent execution risk. Those deals have to work out. There's geographic concentration risk being so dependent on the U.S. market. A U.S. slowdown would hit them hard. And finally, that aggressive M&A strategy, while potentially necessary, has temporarily pushed down ROIC. There's a risk those investments don't generate the expected returns or take much longer than hoped.
So bringing it all back to valuation one last time, where does Allegion stand relative to that intrinsic value range we discussed?
Right, our educational DCF analysis gave us that range of roughly $122 to $146 per share, with a base case around $134.
And the market price when we looked was about $137. How does that compare?
Well, $136.80 to be precise. That puts the current market price right in the upper middle part of our estimated intrinsic value range and slightly above the base case estimate. So what that suggests is the market is currently pricing Allegion fairly, maybe even slightly optimistically, reflecting both its quality and the challenges it faces. For a deep value investor looking for a big discount, a large margin of safety, the current price probably isn't offering that compelling entry point. However, for a long-term investor focused on business quality, someone who buys into the CEO's strategy and believes they can navigate these headwinds, today's price might be seen as a reasonable opportunity to buy a piece of a market-leading company for the long haul. It depends on your perspective and risk tolerance.
So the question really becomes for you, the listener, considering Allegion's strong foundations, that crucial strategic pivot, but also the very real economic challenges, do you see it as a fortress set to keep delivering value? Or are those external pressures and the execution risks just too significant right now? Definitely something to think about for your next meeting, or maybe just for your own portfolio considerations. This deep dive was brought to you by Stock Analytics AI. Remember, you can like and subscribe to the Stock Analytics AI YouTube channel for more deep dives just like this one. And check this out. Members get priority deep dives on tickers they request for just $4.99 a month. Plus, over the next few months, we're actually covering all of the S&P 500 stocks exclusively for our members.
And just the usual but important disclaimer. This analysis was generated by an AI system. It's for educational purposes only and definitely should not be taken as financial advice. Please always do your own research or talk to a qualified financial advisor before making any investment decisions.
Until next time, stay curious and keep diving deep.